5.99 to 6.5%. That is the market movement we have seen in the month of March. Similar to our past 2 weekly market updates, it is all stemming from one thing, and it is inflation, or the risk of perceived inflation over the course of the next few months. And none other better to look at it than the Cleveland Fed. So we write a weekly market update every single week here at Secure Choice Lending. And one of the data points that we look at is the Cleveland Fed. So the Cleveland Fed actually predicts the month of March's inflation on the exact day. So on March 4th, only 4 days into the month, Cleveland Fed already has a prediction of what of what the entire month of March's inflation data would be. So on March 4th, they had predicted a 0.22% month-over-month print. And again, as we've talked about in the past, remember, inflation, so as of right now, inflation is 2.4%. That is what's called headline inflation. Talked about it multiple times. All that is just the combination of all 12 months combined. So on March 4th, Cleveland Fed had 0.22% print. Multiply that by 12, 0.2 times 12 gets you that 2.4% number, okay? Which is still above the Fed target of 2, but overall not that bad. March 11th, the 0.22 number went up to 0.47. March 17th, 0.47 went up to 0.67. And then today, March 25th, went from 0.67% all the way up to a 0.75% print. Now multiply that by 12, right? You're talking 5, 6, 7% inflation. So obviously, we know this hopefully is short-lived, okay? Inflation has risen on a month-over-month perspective from 0.2% all the way up to 0.75%. Simply unsustainable. Where are we seeing that most? We're clearly seeing that most in gas prices. But we know this is where the administration has to have that off-ramp, right? We saw it last year. Last year when tariffs happened, the risk of perceived inflation with tariffs caused the 10-year Treasury to move up to 4.5, 4.6. When it happened, what did we do? We backed off of tariff inflation. Similar concept. You will likely see some type of slowdown. Obviously, we've seen that heavily this week, and it's why the 10-year Treasury has moved down from 4.4 all the way down to 4.3 immediately, because we know inflation cannot be at a 0.7% month-over-month print every single month. It's just not possible. So again, yes, month of March, painful. 0.5% in interest rates, 0.75% in inflation, hopefully just a short-term radar. We can look at, hey, maybe in April, and again, we're not going to start April's predictions until April. And again, this can also come down by the end of March as well. We'll have to wait and see. The official print doesn't usually come out between April 10th to April 12th, so we'll look for that. 0.75 is the prediction at this moment. That brings headline inflation from 2.4 to 3.1. Again, blip. Maybe then, hey, over the course of the next few months, we bring that down, and then just remember, March of next year's inflation print, we will be replacing this 0.7% number with a much lower number. Just again, causes short-term pain, short-term turmoil. Hopefully we have this off-ramp coming very soon, and this could just be a minor increase in interest rates, and we will continue with our trend that we were seeing in December, January, and February. So if you have any questions, feel free to reach out.